The market is up over 160% since the COVID low. And the most common question I get in the community on our videos is, should I wait for a crash to buy stocks? The answer is an emphatic no, absolutely not. Do not wait. The S&P 500 hit a low of 2237.4 in March of 2020 after a massive fall in 1 month starting February 19th. For those who've watched the channel, you know that I love looking at the Buffett indicator, but I made my own version for the S&P 500, and we're currently sitting at 112% overvalued as of today, essentially. Okay, fair value of 2,700. So what I did here was I went back to 1928. I took the S&P market cap and compared it to the US GDP. And the reason being is it makes sense. As US GDP gets bigger, the companies within that economy will get bigger as well. So looking and comparing their values versus the entire US economy is a good and reliable way to look at any given time. Where do values stand? So I went back to 2020, March of 2020. I put in the 2237.40, and guys, look at this. We were only 10% overvalued at that point. 10% overvalued. Now for me, the mistake I made was thinking this was the start of something big. Fair value of 2030. Now, coming back to today, look at how fast it rose up though. We were at March of 2020, 2 weeks later, we were at 2761, 3207, 3400. By the end of the year, we hit 3800, new all-time highs. And valuations just kept going up. And then we hit inflation, and just look at fair value just going up and up and up and up and up. So what does this tell us? It tells us don't try to time the market. Dollar cost average. Because even though valuations were high, fundamentals kept getting better and better and better and better, driving up fair value.
Paul, before you go any further, look at this real quick. So this is the cost of timing the market. This is from JP Morgan. So if you invested $10,000 in the S&P 500 between January 2003 and December 2022, if you invested $10,000 in there and you were in the market the entire duration, you made that $10,000 turn to $64,844.
Yeah, that's pretty epic. That's a big return.
You missed the 10 best days, $29,708.
So less than half.
Yeah. Now let's say you missed, I'm just going to go to all the way to the extreme, missing the 60 best days, $4,205.
So the 60 best days.
So you actually lost money.
So how long a period of time was that?
That was from January 2003 to December 2022. So basically,
20 years. 20-year period. In a 20-year period, there were roughly 5,000 trading days. Mm-hmm. And if you only missed the 1%, this 1.2% that were the best days, you lost money.
Yep.
Now, obviously, this doesn't show what if you'd missed the 60 worst days, how well you've done. But the point about this that Mo is making that's absolutely brilliant is sitting there and talking about, guys, you don't know when the good days and the bad days are going to happen. On any given day, it's a 50-50 shot whether stocks go up or down. And over a 20-year period, history has shown that over a 20-year period, as of right now, stocks have always gone up and been the positive. But there's even better news here that I want to show you. March of 2000, the NASDAQ was high flying. It hit 5,100, 5,200, and it went on to fall 83%. But would it surprise you if I told you that if you dollar cost average, starting at the peak, that you would outperform the S&P, which didn't fall 83%? Let me show you what happened. So Mo, this is QQQ, 433%. This is the S&P 520%.
Okay.
This is total return, includes dividends.
Right.
Oh, do you see how much it fell here? This is QQQ.
Yikes.
Look how much it fell.
That's a big drop.
Big drop. And you sit there and go, okay, but it's low value, lower return. However, we went back and did the numbers. If you invested $200 per month, starting at the very peak of the market, in which QQQ fell 83% from there, if you went and did that and also put 200 in the S&P, you know what your returns would have been, Mo?
I'm guessing the QQQ is a little better.
Not a little bit better, Mo. Annualized return of 13.5% versus the S&P at 10.5%.
Oh my gosh.
And you know what the funny part is? The S&P has not done 10.5%. That's the key to dollar cost averaging.
Wow.
But you have to have the stomach. That's what we're trying to teach on this channel. That's what we teach in our community. You have to have the stomach to say, 83% down, I'm still going to add money to it.
Yeah.
And that's hard to do.
Mm-hmm.
But that's why you have to be around like-minded investors, like-minded people. So make sure your dollar cost averaging is like clockwork, like a robot. I'm doing it every single month to hit my goals. but take a portion of your money if you want to have some fun and pick individual companies, but don't force it. You've got to learn a process that you can understand and you can implement in buying great companies at great prices. Another thing is, most of our viewers are sub 45 years old. So you've got decades before you retire. The great news is, the biggest fear that people have is seeing their account go down. Mo, if you weren't adding money, if you're not adding money every month to your account and it goes down 20%, you feel that.
It sucks.
But if you're adding money every single month to your 401k, your IRAs, and your other brokerage accounts,
it balances it out.
It can help balance it out so you don't feel the emotional effects of seeing your account go down as much.
Yeah, you don't feel 20%.
You don't feel that 20%. You might even break even or go up depending on where you are in your savings plan. I mean, it's all over in our community. We'll have young people who said, hey, I started out with $1,000 and now I have 50 grand in my account because I just started adding as I made more money. You're not going to feel the stocks going down 50%.
No.
Use that to your advantage. It absolutely is scary to see accounts go down. No one's immune to that. But that's why I don't look at my accounts every day. And it's funny, I look at my account once every 6 or 8 weeks and I'm like, oh, and I basically know like, oh, if stocks are up, mine's probably up. If stocks are down, mine are probably down. Because I have some companies. I also have a lot of treasury bills making 4.5%. It's probably basically, even if the market goes down, I'm not going down as much. These are the things I do. You have to program yourself properly. But the key to all of this is you've got to remember, even when markets go down, there's a way to outperform, but it just takes time and it takes discipline. Mo, the discipline of doing it, that's hard.
It's very hard.
That's probably the
hard
biggest.
To do alone too.
And yes, it's very hard to do alone.
Yeah.
And the most common question we get is, Paul, should I wait for the market to crash?
Yeah.
Because of that. And it's hard to sit there and say, especially when we sit at these valuation levels, Mo.
And not only that, but seeing, not in just valuation levels, but seeing on TV and seeing on Twitter and every day, new record highs. And you're just like, well, it can't be a record high forever.
Yeah, especially when valuations are like this.
Yeah.
Guys, I look at this saying, listen, I've been saying things have overvalued for a long time. Even when I started at 3,000 in the S&P saying, listen, things are massively overvalued. And guess what? We still don't have fair value at the S&P at 3,000, but compared to 3,000, this isn't very overvalued. 2,750? That's not that bad. And as GDP goes up, as it drives up, we could see prices fall significantly, but what's going to happen in fair value? It'll probably still go up. Because remember, what's a recession, Mo? What's the definition of recession?
2 consecutive quarters of declining GDP.
But what GDP? It's real GDP, not nominal.
Yeah.
So what that means is real GDP factors in inflation, takes out inflation in there. You can have nominal GDP, which is the actual number, going up while real GDP is going down. So you can still have this fair value going up even with a recession. And that's a big thing to remember. So you're going to, over time, if we were to wake up 20 years from now and GDP is, instead of 27 trillion, it's 65 trillion. My guess is, where will fair value be on this S&P? It'll be about 6,500 on the S&P. But remember, the big key to this and the wonderful brilliance of doing a dollar cost averaging on the QQQ and S&P is it's about that discipline of doing it every single month. This is why we talk about it over and over. When Mo says it's hard to do alone, that's why we created the community. We sat there and said, listen, investing is a lonely road. You're out there on your own, watching TV, getting affected by the news. We're all affected by the news. It takes a long time to be able to go and say, F the news. We've gotten to that point.
Yeah.
I chuckle at the news now that I see the BS in the news. But if you're new to it like I was back in the day, I was drastically affected by the news. I would see a Yahoo Finance message board and believe the things they were saying.
Yeah.
I used to believe that stuff.
Yeah.
All these idiot trolls would say stupid things. I'm like, oh my God, they're probably
that might
right.
be true.
Now I laugh at it. I just go, oh, look at these idiots.
Yeah.
All I know is nobody has a clue what's going to happen next. Have you ever noticed on red days what people say in our community?
Yeah, they're happy.
Oh yeah, people are so ecstatic. They see stocks down a lot. They're like so excited.
Because they get an opportunity to dollar cost average.
Yeah, but is that the mentality of most people?
No.
Even even wealth managers we know, they'll sit there and say, oh, it's been a tough market this month. I'm like, really? Your clients can buy better companies at better prices. Why is that a bad thing?
Yeah. Just go watch CNBC the day that the market's down 2-3%. There is sheer panic, and they have these guests on that are just trying to calm everybody down.
They have day traders acting like investors on CNBC.
Yeah.
And that's the thing that's great about a community. People in the community are real investors.
See through that crap.
To me, a real investor is somebody who sees an opportunity to buy something for less and says, I want that. The fundamentals haven't changed. All that's happened is the stock is cheaper. Why would I not want that? Right. That's the difference we want to do. And you look at our stock analyzer tool.
Yeah.
That thing's used 500,000 to 1 million times per year by our community members and growing. Why? Because the most important question you have to ask yourself when you find a company you like is, what's the right price?
Yeah.
That's what every investor needs to remember. Buying at the right price. Now remember, that's on an individual stock basis.
Yeah.
On the ETF basis, you just got to bank on long-term dollar cost averaging. The most extreme version I can find is the 83% drop in QQQ over 3-year period, and yet you still outperform the market by 30%.
Right.
By dollar cost averaging.
So there's a company that was down 17 or 18% last week. I was telling Dalton, I'm like, anytime I see a 17 or 18% pullback on a stock that I own, I'm probably buying more.
Exactly.
In a single day.
Exactly.
And the next day, right back up.
Well, what was it called? PDD or PPD from China. I sold puts on them at 90 when it fell to like 98.
Yeah.
And it skyrocketed from there.
Yeah.
It's just like, okay.
The news is silly.
And if I gotten it, I was very happy at 90. Very happy at 90 to have that company.
Yeah.
These are the things that we're trying to teach the community, and this is why we have a community. You know, it started with an Excel sheet in the back of literally our monitor, and people saying, hey, how do I get that Excel sheet? I'm like, well, you can't. It's an expensive data feed. And then it sparked with us. Why don't we just offer it to people? So guys, if you're interested in joining that community, interested in sleeping better at night and probably making better returns, click on the link in the description below, because the big key is we're making changes to this software every single week, every single month, every single year. We don't know what's going to be included and not included. But what I do know is, as of right now, everything is included in your membership. And we only have we have a limited number of daily spots for people to get that. So if you go there now, you'll be grandfathered in for life with everything we've made so far. It's the best deal we're going to offer. And better yet, you're going to be locked into your pricing tier forever. So as our price doubles and triples, you're still in your one category. So this is the great thing to do. Go there, sign up before everybody else, before we make our changes. Because once we split things up, it's going to be a lot more expensive. And guys, at the end of the day, it's $7 for 7 days to try it out. What's your downside? Versus what's your upside? And that's what a good investor does. They know their upside is way better than that. Oh yeah, I heard a great analogy the other day about investing.
Yeah. Versus
baseball. You know, everybody makes a baseball analogy. Warren Buffett does. What's the most runs you can score on one swing of the bat?
4.
That's what's great about investing. In investing, what's the most runs you can... Infinite. You can literally compound. And that's what the great investors did. They let compounding work and work and work. And that's the mentality I want everybody in our community to have. And I think the vast majority do have. So if you want that mentality, click the link, description below, go sign up. So guys, dollar cost average in the low cost ETFs. You can beat the market in the long run just by dollar cost averaging. And if you want to see the 3 ETFs I will never sell, watch our next video. Thank you for your time.